All right, everyone, thanks for tuning in and listening to this episode of the Hawaii Retirement Show. Today's episode, we're making sense of gold. We'll talk about gold, what it is, why people should care, how gold has behaved historically in the markets, and the role it can and cannot play in your portfolio, possibly. So we'll talk about all that stuff, break it down here. Reason it's kind of pertinent is gold has been in the headlines quite a bit lately, and rightfully so. It reached a record high at the end of 2025, and it broke $4,500 an ounce. It was above that, and I don't follow it closely, but I think in 2026 it's still trading very close to those record highs. So I thought it was a good time to kind of bring it up and kind of talk about what it is and what it isn't. I don't normally like talking about the markets, market commentary, and I definitely don't want to give specific, investment advice here. This is all educational in nature. I'm not going to, vote for or against gold, just kind of talk educationally about what it is, the role it's played historically, and potentially how you can view it as an asset. Okay, so I think a good place to start off is talking about the gold standard, right? Because we all know gold, it's had its purpose in economies, throughout history. It was, money way back in other cultures, right? We think back to like Spanish gold coins and all that kind of stuff. But we're talking modern times here. We had the gold standard, right? And the gold standard essentially was kind of, you tied the country's currency directly to gold, right? Each unit of currency represented a fixed amount of gold. And this allowed, people and governments to exchange currency on that gold, that fixed rate that was directly tied to gold. Now, the money supply was limited to how much gold a country could have, right? Because you can't have more money than the value of gold when you're operating on this strict gold standard, right? And so for much of the 19th and early 20th centuries, this system created stability, right? It created a stable exchange rates between countries, between people. It was all tied to the same underlying asset of gold, right? So it provided price stability. It provided trust, right? There was trust in money because it was backed, right? Especially when you're dealing with international trade, right? It's backed by the same underlying asset and value. And it also, it kind of forced people to be disciplined in that, like we think now we can just print money and stuff like that. And when it's tied to gold, it makes you, it kind of limits you, but it also enables you to be disciplined. It sets up kind of a guardrail where, you can't continue to print money, cause inflation, all this other stuff. There are a lot of downsides to the gold standard, and that's why we, eventually moved away from it, right? Because for the pros of kind of that discipline and financial stability, that also creates a lot of cons in that there's limited flexibility, especially during, crises, wars, whatever it might be, right? And it kind of handcuffs or limits the government's ability to react to like recessions, depressions. It also could potentially lead to deflation, right? When economic growth, right? You have a lot of growth, let's say GDP, right, is really high, but you're always tied to this gold supply. That kind of, economically can result in deflation. So the gold standard, it favored stability over flexibility, right? But in modern times here, we've all moved away from the gold standard. The U.S. formally abandoned the gold standard in 1971. And that's when the dollar became the fiat money, and it was just backed by the government trust, right? It's backed by the U.S. government. That's where, the value lies So currencies today, now that they're not on the gold standard, they float and are managed by central banks, right? Through monetary policy, right? Without getting too deep in the weeds of economics, but we have fiscal policy and monetary policy, right? The central banks and monetary policy are what are kind of managing the money supply, so to speak. So the gold standard, I mean, it still kind of matters in that, we have gold reserves. A lot of countries have gold reserves, and it can kind of be a check on how much money creation we've done moving away from the amount of gold reserves that are there. I think any calls to go back to the gold standard are usually in correlation to concerns about inflation and debt, but they're not really practical. And I think there's a slim to none chance we will ever go back to a gold standard, but I could be wrong. Okay, so let's move on to how gold has actually behaved in market history. We'll talk about certain time periods, what was happening, what gold did in response to what was happening, and some lessons and takeaways from that time period. Okay, we'll go over just a few of them. Let's start off with the 1970s. In the 1970s, it was the end of the gold standard. Remember, I said the U.S. moved away from the gold standard in 1971. There was high inflation, oil shocks, and weak confidence in government policy. Okay, that's what was going on. And what did gold do in response? Gold prices rose dramatically over the decade, but it's worth pointing out that it wasn't smooth. It's not just it wasn't a steady, smooth rise over the whole decade. And I think you could look at the reason for the rise was sustained inflation, right? We had high inflation. Gold was responding to long-lasting inflation, plus you had policy uncertainty, right? That sounds like a prime time for gold. High inflation and weak confidence in government policy. Okay, so that's the 1970s. The 1980s and 1990s, you could think of as the lost decades for gold. Okay, so let's talk about what was happening in the 80s and 90s. You had high real interest rates, strong economic growth, expanding stock markets, and high confidence in institutions, right? There wasn't this lack of confidence there. And so what did gold do? There was long periods of stagnation and actual decline in real terms, right? So it underperformed productive assets, other investments, kind of badly in the 80s and 90s. And I think the lesson takeaway is, there's always that chance that gold can underperform for years or even decades. And we can see that in the 80s and 90s. When things are going good, we got strong economic growth, expanding stock markets, and the confidence, I think that's the key one, and the confidence is high in institutions and government, then gold can definitely underperform. Okay, let's look specifically 2008, 2009, right? The financial crisis, the great financial crisis there. What was happening? Okay, banking systems were stressed. We had market panic. We had liquidity crises, right? Run on the banks. And there was an overall fear of financial collapse here. And so what did gold do? Well, what's interesting here is it initially fell during the sharp sell-off, right? It fell, just like everything else. Then it recovered and then had a good strong rally as things kind of progressed and confidence continued to erode in the financial markets. And I think the key takeaway from 2008, 2009, the financial crisis, is what we saw is gold wasn't a day one crisis hedge, right? It fell just like everything else. But in the aftermath, gold did have a strong rally because of the fear of financial collapse and the low confidence in the financial markets. That's what caused the gold to rally. But initially, it kind of had a sharp sell-off just like everything else. Okay, so 2011 and the period following thereafter, we had kind of this peak fear and peak gold situation, right? Gold obviously tends to peak when fear is widespread, right? And so what was happening in 2011 and the subsequent years? So we had the Eurozone debt crisis, which was a huge deal. We had the U.S. debt downgrade, which was another huge deal. And 2008 was only a few years ago, so it's fresh in everybody's memory. And that kind of fear in the financial market still existed. Okay, so what did gold do during that time. Well, it reached all-time highs, right? But it then entered a long period of underperformance. And the reason or lesson here that we can take away was gold prices can overshoot, kind of their value during periods of fear, right? When gold is on this rally and people are pouring money into gold, there's a good chance it overshoots its underlying value there, right? So I think another lesson and takeaway from this time period is timing gold on headlines is extremely difficult, right? Because things can change, right? It's like timing the market. Timing the market requires you being right twice. You need to be right when the market is about to change, whether that's to go, up or down. And you have to be right on the timing again when it's time to jump back in. Like when are you calling for the bottom, and when are you calling for the top, right? When are you jumping back in? It requires being right twice. Okay, and so timing gold based on headlines and the overall sentiment, it can be really difficult, especially when you know that it can overshoot sort of its valuation when fear is high and people are pouring a lot of money into gold. Okay, let's look at 2020, right? The pandemic, the COVID-19 pandemic. And you could make a case that gold didn't really react to COVID itself, but it reacted to like the policy in responses to COVID, right? So let's talk about what was happening. Obviously, we had the big pandemic. There was global shutdowns, massive uncertainty, and the central banks were flooding the system with liquidity at this time, right? We had extremely low interest rates. We had the stimulus. There was a lot of money being tossed around during this point. So what did gold do? It's similar to how it reacted to the 2008 financial crisis in that it dropped briefly during the initial market crash, right? It dropped. And then you saw this surge as, the monetary expansion and the stimulus money. And then you saw gold surge up, right? Because we still had that massive uncertainty and gold reacted to it, right? So I think the lesson and takeaway here is that gold definitely responds to policy reactions just as much, if not more to, than the actual events, right? It's the policy reaction, it's the massive uncertainty. That's really what's going to drive gold and its movement up or down. Okay, and so in modern times here, when we're talking the past few years, right? I mean, we had in 2022, we had high inflation, we had the rising interest rate hikes, we had rising yields, and gold, despite all of that, it really didn't do much. It just kind of stayed stagnant until recently. That's when gold kind of just in the past, I don't know, year or so, it's kind of gone on its bull run, maybe 2 years. I don't know. I wasn't following it too closely, but it's gone on this bull run to where it's now, reaching all dots looking forward. But I think a lot has to do with uncertainty, uncertainty in maybe, the U.S. debt. We had the Liberation Day with the tariffs. And there was just a lot of uncertainty there. And I think that in part could be a reason for gold's recent run. And that kind of wraps it up for the different time periods. I just want to go through and talk about some lessons learned and what was going on and how gold reacted throughout certain times in market history. Okay, so let's talk about gold as an asset and its possible role in your portfolio. So gold, it doesn't act like an investment in the traditional sense in that, or like a stock or business, because it doesn't have cash flows, it doesn't have dividends, there's no earning growth. It's kind of just a store of value. It's a store of monetary value, or you could say it's a monetary alternative. But it's not an investment in the traditional sense of a stock or business, in that there's not that earnings growth, the dividends, the cash flow. And the same could be said for cryptocurrency as well. There's no underlying asset of cryptocurrency. At least with gold, there is an underlying asset that can, store value. And looking long term, given everything we've gone over to this point, when you zoom out over long horizons, gold hasn't beaten stocks, bonds, or just other businesses over long periods. At best, gold has kept up with inflation, but generated roughly a zero return once you factor in inflation, right? So it's important to understand, you can look at things, any investment, the time period dictates its behavior in return, right? If you look at things in a vacuum, you could say, gold does really well there, or this is when, this sector of the market tanks or whatever. But it's always good to take the 10,000-foot view. Let's zoom out, look over long periods. And when you look out through gold through a long period, you could say, well, gold has done a good job at keeping pace with inflation, which makes sense as its role is kind of, a store of value, a monetary alternative. But it hasn't really come close to beating stocks, bonds, and businesses over the long term. Okay, so gold's role in a portfolio. You could make a case that gold acts as a diversifier, right? It adds diversification to a portfolio, which means it can reduce portfolio volatility. And I think that's true. It's worth pointing out, though, that diversification doesn't mean higher returns. It means reduced portfolio volatility, right, with low correlating assets. Diversification is good if you're using diversification for the right reasons, right? Diversification isn't used for growth. Diversification is used to reduce portfolio volatility in the simplest sense, okay? I'm sure there's some CFAs out there that would could argue the other way. Practical ways to own gold. You can own the physical gold, right? You could buy the bars or the coins or whatever it is, and you could store it. There's liquidity issues there, right? Selling it's a little difficult. The other option is there's a lot of ETFs, right, and different funds out there that you can purchase gold or have access to the asset class through these ETFs or funds. Another method of doing it, if you really love gold, is maybe you invest in mining stocks or, companies affiliated with gold, right? It's a way of kind of being under the gold umbrella without actually owning gold asset itself, right? So how much, if any, makes sense, right? That's probably what you're wondering. People who think about gold, how much gold should I buy? How much should I hold? And I think there's no right allocation, and I'm not giving any investment advice here. But it's important to knowing, like, if you think about your portfolio, what is considered a concentrated position? There's no definitive term for that, or there might be, I'm not aware of it. But I would say like 10%, right? If you own 10% of any individual stock or asset class, that is what I would consider a concentrated position. Now, if you own 5%, I don't think that's a huge allocation looking at the entire portfolio. And I also think when we're talking to gold, I think zero is a completely valid allocation, right? I don't think you have to own gold. And I don't think you shouldn't own gold, right? I think zero could also be a valid allocation for gold, right? I think a lot of people like gold for psychological and emotional reasons, and I don't think that's a bad thing. I don't think it's a good thing. It is, right? Some people like gold because it helps them sleep at night. They think it's, holding value. It does something for them. And these people, they get anchored to it, and I think that's fine if there's an emotional reason or some speculation that you have about gold in the future. I will say that sometimes you hear doomsdayers really push gold, and they say, well, if the financial markets collapse and if the modern financial system we have goes under, you want gold. My thought there is, if the financial systems collapse and the financial world that we operate under goes under, right? The financial markets go to zero. I don't think people are going to care about your gold at that point. I think at that point, you're going to really want to make sure you got yourself some food and some weapons and get ready for a not so pleasant scenario if the financial world just collapses, right? We're in big trouble if that's the case, and that's a world I really hope doesn't happen. I don't live in, and I don't think gold is going to help you in that world if that scenario comes to fruition. But again, with all this, I could be wrong. So let's wrap it up here. A lot of people say gold always protects you in a crash. Yeah, sometimes, not always, right? Gold keeps up with inflation every year. Sometimes, not always. Zooming out over the long term, you could make that case for sure. Gold is safer than stocks. Well, sort of, but not really, right? Gold has a lot of volatility as well, and it goes up and down just like anything else, right? So when gold works best, we could say as a diversifier most of the time. Sometimes as a hedge against inflation, usually it does, not always. And that I think we could also say with some certainty that gold is not a growth engine, right? It's not an investment you're investing in for growth. It's more, keeping up with inflation and a monetary alternative, right? But it's not a replacement for productive investment assets. I think we could say that with some level of certainty here. So the portfolio construction matters. How much should you own? That's up to you. We talked about, maybe somewhere around 10% would be considered a concentrated position within a portfolio. And that zero allocation of gold works for a lot of people, right? I myself do not own gold. And that's all up to you. Consult with your investment legal tax advisor if you have questions, or do your own research and figure out what amount works for you. I think I'll leave off with a quote from Warren Buffett on gold when he's talking about gold's role versus productive assets. Buffett says, "Gold is a way of going long on fear, and it's been a pretty good way of going long on fear from time to time. But the gold itself doesn't produce anything." It's a good quote, puts it in context. Coming up on the show, I think working out something with Andy Panko, bring him back on. Possibly Professor Trey Spilker from UH, have him back on to talk about some things, and a couple other guests, and we'll see what comes down the pipeline here. But as always, if there's anything in particular you'd like me to talk about on the show going forward, email it over to aloha@hawaiiretirementshow.com, and I'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by Toba Financial. For Jason Katita, investment advisory services are offered through Toba Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.